48 hours ago, the global financial system crossed a threshold that most investors don't even realize exists. But for those who understand the dark liquidity metrics, the numbers are bone-chilling. In a single trading session, $1.4 trillion in nominal value vanished from the S&P 500, not because of a standard sell-off, but because of a systemic liquidity lock that has now frozen the repo markets. This isn't just a correction. It is a structural failure of the very plumbing that allows global commerce to function. Before we dive into the forensic data that proves why tomorrow could be the start of a permanent collapse, make sure to subscribe to the Money Files channel, your source for institutional-grade market analysis. We're staring at a Black Sunday scenario where futures markets are already telegraphing a 700-point massacre in the Dow. The trigger? An unprecedented spike in the volatility of volatility index, a metric so obscure that most traders don't even know it exists. But here's what you need to understand. The mathematical architecture of 2026 has turned lethal. U.S. national debt just crossed $38 trillion, while interest expenses have quietly overtaken the entire defense budget. This creates what economists call a fiscal death spiral, where the Treasury has no choice but to issue fresh debt just to cover interest on existing debt. It's a Ponzi scheme hiding in plain sight, dressed in the respectable clothing of government bonds. When Michael Burry, the man who saw 2008 coming before anyone else, takes a massive short position against the Magi 7 AI bubble, he's not betting against technology. He's betting against the collateral framework of the entire financial system. Burry knows something the average investor doesn't. When collateral is revealed to be overleveraged by a factor of 30 to 1, the margin calls won't just hurt. They'll be extinction-level events for entire portfolios. Institutional players have already moved to the sidelines. The evidence? Berkshire Hathaway's record $382 billion cash position. Warren Buffett isn't waiting for a bargain. He's waiting for the systemic reset, the moment when assets trade at liquidation prices because there's no liquidity left to support them. Buffett understands what the Shiller PE ratio is screaming right now. At 36, we're in territory only visited twice before in history. Once in 1929, right before the Great Depression. Once in 2000, right before the dot-com implosion. In both instances, what followed was a drawdown exceeding 50%. Both times, the crowd said, "This time is different." Both times, gravity disagreed. The reverse repo facility has drained to near zero. For those who don't speak Fed, this was the final safety valve for banking system liquidity. Without this buffer, any sudden spike in demand for dollars triggers a credit freeze similar to September 2019, except this time it goes global. The eurodollar market is already showing extreme stress, with basis swaps blowing out to levels not seen since the pandemic lockdowns. Translation, the world is desperately short on dollars, and the only way to get them is to sell everything that isn't bolted down. Gold, Bitcoin, even the supposedly invincible Nvidia, all become casualties in the race for liquidity. Here's where it gets truly dangerous. Algorithmic trading bots now control 80% of daily trading volume. These machines are programmed with a simple instruction. If the VIX crosses 35, sell everything simultaneously. This creates a feedback loop that no human trader can interrupt. On Black Sunday, as Asian markets crack open, these algorithms will detect credit default swaps on major US banks spiking, and they'll hit the sell button on every asset class at once. That's how a flash crash transforms into a depression-level event. The AI supercycle has been the only thing keeping the S&P 500 levitating above reality. But look closer at the numbers. The revenue to capex ratio for these companies mirrors the fiber optic bubble of the late 1990s with frightening precision. Billions are being deployed on hardware, but productivity gains aren't showing up in broader GDP. If Nvidia misses its earnings growth targets by even 2%, the deleveraging of the tech sector will erase $5 trillion in market cap within a single week. Not gradually, violently. Forensic analysis of 13F filings reveals something chilling. Insiders have been selling at a 12-to-1 ratio compared to retail buyers. While ordinary investors pile in, chasing the dream, the people who actually run these companies are heading for the exits. They know what the balance sheets really look like. They understand that growth at any cost eventually means collapse at every level. Inflation hasn't been tamed. It's been temporarily suppressed through strategic petroleum reserve releases and supply chain band-aids. Now, as we roll into late January 2026, the commodity supercycle is reigniting. Oil threatens to break 120 per barrel due to Red Sea blockades and escalating tensions in the Strait of Hormuz. High energy prices act as a tax on every consumer, every business, every economic transaction. Combine that with 7% mortgage rates, and you've finally broken the American consumer. Credit card delinquencies just hit a 15-year high, surpassing levels seen during the depths of 2008. The commercial real estate bomb isn't ticking anymore, it's detonating. Over $2.2 trillion in CRE debt matures in the next 18 months. Most of it was financed at 3% and now needs refinancing at 8%. The math doesn't work. Major regional banks are sitting on unrealized losses 3 times their capital buffers. When the first major office REIT defaults this Sunday, it triggers a bank run in the digital age, where money moves at the speed of a smartphone swipe, not a withdrawal line. Contagion becomes inevitable. The Federal Reserve is trapped in a policy prison with no escape route. Cut rates to save the banks, the dollar collapses and hyperinflation takes over. Keep rates high to fight inflation? The entire banking system implodes. They've chosen the latter for now, but the market is about to force their hand. Black Sunday is the moment traders realize the Fed put is dead. There's no bailout coming because the Fed's own balance sheet is bloated with $7 trillion in depreciating assets. Look at the chart that shows valuation versus economic reality. Every time this gap gets this wide, the mean reversion is violent. We're currently 40% above the mean, which implies a collapse that destroys an entire generation's retirement savings. The trigger mechanism? A massive derivative unwind in the Japanese yen carry trade. For a decade, this has been the silent liquidity engine powering global markets. As the Bank of Japan is forced to raise rates to defend the yen, trillions of dollars borrowed cheaply to buy U.S. tech stocks must be repatriated. This forces liquidation of the most popular stocks in the world. When you see Apple and Microsoft dropping 5% in pre-market trading, you're watching the carry trade unwind. What starts as an orderly exit quickly becomes a stampede. The small business sector, the actual engine room of the American economy, is already in a silent recession. The NFIB Small Business Optimism Index has crashed to its lowest point in survey history. These businesses can't afford the cost of capital anymore. They're starting to lay off workers at an accelerating pace. The unemployment rate, always the last indicator to move, is just beginning to tick upward. Once it crosses 4.5%, the Somme rule officially triggers, confirming we're in a deep recession. But by then, the damage will already be catastrophic. Black Sunday isn't just about stock prices. It marks the end of the petrodollar system. As Saudi Arabia and BRICS nations move toward a multipolar settlement framework, demand for U.S. treasuries as reserve assets is vanishing. This means America can no longer export its inflation to the rest of the world. The loss of reserve currency status is the ultimate black swan event, one that could trigger a 30% overnight devaluation of the dollar's purchasing power. Bitcoin and gold have been hitting all-time highs, but not because they're going up. It's because the paper currency they're measured against is going down. They're canaries in the coal mine. When systemic collapse begins tomorrow, even these safe havens may see temporary liquidity washouts as traders are forced to sell winners to cover margin calls on losers. This is phase 1 of collapse, where correlation goes to 1.0 and everything falls together. The passive investment trap is the final piece of this puzzle. Millions of people are auto-investing into index funds that are 30% concentrated in just 5 stocks. This creates artificial demand on the way up, but automatic selling on the way down. When index funds start seeing outflows this Sunday, sell at any price orders hit the market, creating a waterfall decline that forces exchanges to halt trading with circuit breakers. But halting the market doesn't fix insolvency. It only delays the inevitable. High yield spreads are finally widening, which is the market's way of saying default risk can no longer be ignored. We have zombie companies that only exist because they had access to 0% interest rates. Now that money has a real cost, these companies are dead men walking. When credit markets shut down, stock markets follow within 48 hours. That 48-hour window closes tomorrow. Tomorrow morning at 9:30 a.m. Eastern, the opening bell will mark the most important financial event of your lifetime. It signals the end of the easy money era and the beginning of the great deleveraging. Those who are prepared will survive. Those who are all in on the bubble will be wiped out. The collapse isn't a maybe, it's a mathematical certainty based on credit exhaustion. We're witnessing a sovereign debt crisis in real time. From the UK to Italy to the United States, governments are reaching the end of their rope. They've deployed every monetary trick in the playbook, and none of them worked. The velocity of money is crashing, meaning every new dollar printed has less and less economic impact. This is the law of diminishing returns applied to a global empire. Black Sunday is the day the world stops believing in the magic of central banking. Analysis of the options market shows a record concentration of gamma at strike prices below current levels. As the market falls, market makers are forced to sell more futures to hedge their positions. This delta hedging creates an accelerated downward spiral. This is the technical mechanism that turns a bad day into a historical collapse. Tomorrow, the gamma flip becomes the engine of destruction. The retail investor is the last one in the pool after being told for 15 years that stocks only go up. They're fully allocated with no cash reserves. This is the textbook definition of a market top. When panic starts tomorrow, the retail crowd will be last to sell, catching the full force of a 40% decline. As Sunday draws to a close, the global financial order is in its final hours of relative stability. The forensic evidence is overwhelming. Record debt, record valuations, record concentration, record low liquidity. The math simply doesn't add up anymore. The collapse is the system's way of clearing out the rot. It's painful, but inevitable. The derivative market represents the dark matter of the financial universe. At $600 trillion to $1 quadrillion in notional value, it dwarfs global GDP by a factor of 10. Most of these contracts are over the counter, meaning they're private bets between banks that nobody regulates or monitors properly. If one major bank fails tomorrow morning, the counterparty risk will freeze the entire global system in minutes. This is why tomorrow represents the end of the road for the derivative superstructure that's been built over the past 4 decades. The gold to silver ratio and the gold to S&P ratio are both signaling a massive rotation out of financial assets and into real assets. But here's the problem. The financial market is so much larger than the physical market that there is not enough gold and silver in the world to absorb even 1% of the capital flight. This will lead to limit up moves in hard assets, while the stock market goes limit down. Eastern central banks have been dumping U.S. treasuries for 24 consecutive months, pre-positioning for the collapse of the dollar standard. When the anchor of the world's financial system, the 10-year treasury, is no longer seen as risk-free, the discount rate for every other asset in the world goes up. This is the gravity that will pull the market down tomorrow. Tomorrow, the market will not survive the weight of its own contradictions. This is where speculation ends and reality begins. The market has run out of greater fools. Every buyer has already bought, and now there are only sellers. When supply-demand balance shifts this heavily to one side, price must gap down to find liquidity. That gap tomorrow will be the largest in New York Stock Exchange history. We're entering the season of accountability. For 2 decades, we've lived by borrowing from the future. Now the future has arrived to collect. The forensic data proves the collateral is gone, the credit is exhausted, and confidence is shattered. Black Sunday is the expiration date of the global debt experiment. Tomorrow, the bill comes due. The market is a complex adaptive system, and right now it's adapting to a world where money is no longer free. This adaptation manifests as collapse for those holding paper assets. We're moving toward a hard asset world where cash flow and tangible value are the only things that matter. Tomorrow is the day of reckoning for virtual wealth created by Federal Reserve printing presses. As futures markets continue bleeding in the final hours of Sunday, realization is setting in among institutional traders. The game has changed. The old rules no longer apply. Tomorrow, the opening bell rings, but for the bull market, it will be a funeral bell. The banking sector is concealing $1 trillion hole in held-to-maturity portfolios. These are bonds purchased when interest rates were at 1%, now worth only 70 cents on the dollar. As long as banks don't sell them, they don't have to mark the losses to market. But if a liquidity event occurs tomorrow, as Black Sunday suggests, banks will be forced to sell these bonds to meet withdrawals, turning unrealized losses into actual bank failures. This is the Silicon Valley Bank scenario, but for the entire top 20 banking system. Corporate credit analysis shows that interest coverage ratios have fallen to dangerous levels. Over 20% of the S&P 1500 are now zombie companies, meaning their profits don't even cover interest on their debt. They survived only because they could roll over debt at low rates. Tomorrow, the credit window slams shut. When a company can't refinance its debt, it doesn't just decline in price. It goes to zero. When the clock strikes midnight on Black Sunday, the illusion of a stable global financial system evaporates, leaving behind a $4,500 trillion derivatives mountain that's starting to slide. What we're facing isn't systemic risk, it's systemic failure, a moment where mathematical models used by every major Wall Street bank simply stop working because they never accounted for a zero liquidity environment. This isn't just about stocks declining. It's about the transmission mechanism of money itself breaking at the seams. The price discovery process becomes a price destruction process. Eurodollar futures show an unprecedented inversion, signaling a catastrophic global dollar shortage. When the world runs out of dollars, it doesn't just stop buying stocks. It stops servicing debt, leading to a cascade of defaults starting in emerging markets and ending at the U.S. Treasury's doorstep. Black Sunday is when the dollar trap finally snaps shut, catching every nation that borrowed in greenbacks but earns in local currency. Margin debt has surged to a record $750 billion, but that's only the visible portion. Factor in shadow leverage through total return swaps used by hedge funds, and real system leverage exceeds $2 trillion. On Black Sunday, as the first 5% drop hits indices, these swap agreements trigger automatic liquidations. This is why a 2% correction can transform into a 20% collapse in hours. Computers are programmed to de-risk at any cost, and there are no human buyers to meet them. The Magnificent Seven tech giants have been lifeboats for the entire market, but those lifeboats are now over capacity and sinking. If these 7 stocks return to mean valuation, the S&P 500 drops to 3,200 overnight. Central banks spent a decade suppressing volatility, which is equivalent to forest rangers putting out every small fire. The result? A forest filled with deadwood waiting for a single spark. Black Sunday is that spark. By preventing small corrections, the Federal Reserve ensured the big one will be an extinction-level event. We're witnessing a consumer credit crunch unprecedented in the modern era. The savings rate has hit a record low, while buy now, pay later debt has exploded. The American consumer is completely tapped out. On Black Sunday, the realization hits that the consumer engine of the economy has finally stalled. Without the consumer, there's no earnings growth. And without earnings growth, current PE ratios are a mathematical impossibility. The geopolitical risk is no longer a tail risk, it's front and center. As BRICS Plus nations move toward a gold-backed settlement system, the recycling of petrodollars into U.S. treasuries is ending. The structural shift means the U.S. government will have to fund its $2 trillion annual deficits from internal savings, which don't exist, or through Fed printing. Both options lead to collapse of the current monetary order. Tomorrow morning, the world changes. The opening bell arrives, the collapse is here. For those with knowledge and preparation, there's opportunity in the rubble. For those caught unaware, the wealth destruction will be generational. The forensic evidence is complete. The math is terminal. The result is tomorrow. The commercial real estate fallout is moving from office to multifamily. High interest rates have made cap rates on apartment buildings unattractive, leading to a wave of defaults among private equity landlords. This hits pension funds that have been chasing yield in these alternative assets. Black Sunday may be the day your pension fund announces a haircut because its private equity holdings are being marked down by 40%. Wealth concentration shows that the top 1% hold more wealth than the bottom 90% combined. This inequality gap has reached breaking points seen in 1929 and 1789. History shows that when financial bubbles pop, social unrest follows. The market collapse tomorrow isn't just a financial event. It's a social catalyst that will change the political landscape for the next decade. As the Sunday night session progresses, spreads on high-yield bonds are blowing out to 1,000 basis points. This is the market saying bankruptcy is the new base case for the corporate sector. When credit disappears, equity has no value. This is the fundamental law of finance that was suspended for 15 years and is now reasserting itself. The collapse is the cleansing the system desperately needs. But for the unprepared, it will feel like the end of the world. It is the end for cheap credit, passive indexing, and asset inflation. But it's the beginning of a world where value, productivity, and hard assets are the new kings. This Black Sunday will be remembered as the pivot point of the 21st century. It's the day debt-based prosperity finally ran out of future. The forensic evidence is inevitable. The math is terminal. The result is tomorrow. This is your final warning. Black Sunday has arrived. Are you ready for what comes next? If you want to survive what's coming and position yourself for the opportunities that emerge from chaos, subscribe now. Because when tomorrow's opening bell rings, there's no going back. The Great Reset begins at dawn.